This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, we're now moving into the last area of the Paper F5 syllabus, which is performance measurement. And there are various topics examined under this heading. There's financial performance, non-financial performance, divisional performance, transfer pricing, which fits in with divisional performance, and performance in not-for-profit organisations. And so there'll be several lectures here. The first thing I want to look at is financial performance. And I hope you've got the lecture notes in front of you, because all right, the job of the management accountant is to improve the business, to make it more profitable, and so on. And so, of course, we need to measure how well are we performing. Are our measures improving things or not? And the most obvious thing of all is the financial performance, that clearly we want the business to be more profitable. But there are several things that you could be required to look at. And you'll see on the first page of this chapter, the main areas we want to consider are profitability. Obviously, we want the business to be more profitable. Liquidity. It's one thing being profitable, but at the same time, the company needs to be able to pay its bills. You know, there's several examples I could give you of companies which have been making profits, but have run out of cash and ended up having to close down. And a lot less important to Paper F5, to be honest, but gearing, looking at how the company is financed. Now, we're going to look at various measures that you could be required to look at. Although I must say, in Paper F5, there's not a lot on pure financial performance. But to be safe, I'll go through all the standard ratios, which in fact you should have seen before at Paper F2. But it won't take too long to go through them, and it's very much just a question of learning. And you'll see on the second page, I've given you the financial statements for a business in both 2007 and 2006. You've got, first of all, the statement of financial position, which you should be happy enough with, the non-current assets, the current assets, so the total assets in 2007, 3655, the liabilities and capital. You've got your share capital and reserves, the retained profit. The non-current liabilities is this loan, 2007 at 500, and the current liabilities, trade payables, tax payable, dividends payable. So a standard statement of financial position. And then I've given you the income statement, or the statement of profit or loss, again for both years, revenue, cost of sales, gross profit, distribution costs, admin. The profit from operations in 790 in 2007. The finance costs, that's the interest, giving a profit before tax of 740. The tax 262. So the profit in 2007 is 478. And strictly the statement of profit or loss finishes there. But they have obviously paid some of it out as dividends, 169, and they've retained 309. Anyway, fairly conventional set of statements there. And let's go through the standard measures, which just could be relevant, or some of them could be relevant in a Paper F5 question. First of all, most important of all is profitability, and of course it's stupid just to look at the profit in isolation. You know, 2007's profit is higher than 2006, fine, but just to look at absolute profit is a bit silly. You know, if the company's twice as big, if you're selling twice as much, you'll expect to make twice as much profit. And if you don't, you know, what's gone wrong? And equally, if you've expanded the business, if you've bought more machines and things, again, you'll be expecting anyway that there should be more sales and more profit. And so we do need to combine the two to look at ratios. And so on the next page, I've written what you might call the formulae, the standard ones. Let's run through first of all the profitability ones. Just check you're happy with the calculation of it, and that you are able to make not a lot but a few sensible comments on what comes out of it. So let's run through first of all these profitability measures. And in no particular order, I'll do the order on the sheet. First of all, the net profit margin. I won't write down the formula itself because you've got it in front of you. But be careful here, because financial accountants often refer to net profit slightly differently. But here we look at the profit before interest and tax as a percentage of the revenue. So net profit for these purposes, profit before interest and tax, it's not the very final profit, it's the net operating profit. So if you look at 2007, the profit before interest and tax, the operating profit, the profit from operations is 790. For the net profit margin, we express that as a percentage of the revenue. The revenue in 2007 is 7180, and so as a percentage I get 11%. Now on its own that means nothing at all. Is 11% good? Is it bad? The only relevance is when we come to compare either with similar companies, we're doing better or we're doing worse, or with previous years. And so here, if we compare with the previous year, in 2006, the operating profit is 462, or was 462, the revenue 5435. And so again, as a percentage, it was 8.50%. And so, I'm probably saying too much, but as I said before, simply the fact that the profit itself has gone up doesn't tell us very much, because sales have gone up as well. It's the percentage that matters. And I think fairly obviously, here, on this alone, we seem to be doing well. The next one though, net profit increasing, the two things affected. One is, are we selling our goods at a higher price and making a bigger gross profit? Or have we achieved that increase by simply cutting our expenses? And so to get a bit more detail on it, the next one, the gross profit margin. Almost defines itself, but again, we've got the formula there. The gross profit is a percent of revenue. So in 2007, the gross profit 1795. The revenue 7180. So in percentage terms, 25%. Obviously higher than the net profit margin. In 2006, though, what was it? The gross profit was 1223. The revenue 5435, and so 22.5%. So again, things so far look good. We've increased the gross profit margin. Either we're selling things at a higher price, or we've managed to cut the cost of the goods we're selling. But either way around, it looks fine. Next one, the most important one of all, to be honest, the return on capital employed. I said when we started that, okay, we always want more profit, but if we've expanded the company by raising more money, raise more money, buy more machines and so on, if the company's a lot bigger, we'll be expecting more profit, we'll need more profit to be doing as well. And so, again, you can see the formula. It's the profit before interest and tax over the total long-term capital. Now check you're happy what we mean by both of those. The profit before interest and tax I've already dealt with is the operating profit. So in 2007 is 790. The total long-term capital is the total long-term money in the business. And the business raises long-term money from two places. One obviously is from shareholders. And so if you look at the statement of financial position, the total raised from shareholders, share capital and reserves is 2190. And in addition, they've raised long-term money from non-current liabilities, the long-term loans, which again in 2007 is 500. So the total long-term money in the business is 2690. Whether it's all borrowed from shareholders or whether some of it's from shareholders and some of it's from loans, doesn't matter. That's the total finance in the business. And so on that excuse me, on that amount of finance, they're earning 790. So in percentages, 790 divided by 2690. Return on capital, is that right? Seems rather right. 790 divided by 2690. 29.37%. However, yet again, on its own, that means nothing. It's only if we're comparing with similar companies or with previous year. Here we can only compare with the previous year, so the operating profit in the previous year was 462. The long-term capital employed from equity 1401, from debt borrowing, non-current liabilities 400. So a total of 1801. So the profit 462 divided by 1801 is 25.65%. And so the business is quite a lot bigger. The capital's gone up from 1800 to 2700. We'd expect more profit. But in percentage terms, well, we have actually improved the profitability, 25 up to 29. One tiny thing, just because some books quote it differently. The long-term capital employed, if you just look at 2007, it's the equity, shareholders' money, plus the long-term debt, the non-current liabilities. Do appreciate, depends what information you're given in a question, that that's always going to be the same as the total assets minus the current liabilities. Just check for 2007. You see the total assets, current and non-current, is 3655. The current liabilities, where are they, are 965. And so total assets less current liabilities comes to 0.962 2690. You know, it must always be equal to equity plus non-current liabilities. So it doesn't matter. Some people write it one way, some people write it another. What's important, obviously, is to get the right percentage. All right. After return on capital employed, now any company wants to increase that, but in fact there are two ways of increasing it. How can we make that higher? One way is just to become more profitable in what we sell, to increase our profit margin. And we have increased our profit margin, we saw it earlier. The other way, though, is to use our money more efficiently. You know, in 2007, we've got 2690. The more efficiently we use our money, more efficient our machines are, the more we can produce and sell, the more profit we can make. And so we can, in fact, look at the two bits separately. You'll see what I mean when we've done the next one. Now, the next one here is the asset turnover. And as hopefully I explain, this is measuring how well we're using our long-term money. And it's defined as being the revenue over the total long-term capital. So again, 2007 first, we're generating revenue of 7,180. On how much long-term capital? Well, same as before. The equity plus the long-term debt, the non-current liabilities, 2,690. And so 7,180 divided by 2,690, I get 2.67. And this one, generally, we don't write as a percent, just as a multiple. So this year, we are earning revenue of 2.67 times the size of the company, the total long-term money. What was it in 2006? In 2006, the revenue was smaller, obviously, 5,435, but there was much less long-term capital. The company was smaller, and the long-term capital, equity 1,401, long-term debt 400, 1,801. So 5,435 divided by 1,801, I get 3.02. So that's actually, this year, we've fallen down a bit. You know, last year we were selling 3 times the size of the company. This year it's only 2.67. So on its own, that's not as good. However, slightly more to say, I said a minute ago that the return on capital, we always want to improve return on capital, and you either improve it by selling more for the size of the company, or you improve it by increasing the profitability on what you do sell. And so, quite importantly, and it's written down below, the return on capital does equal the asset turnover times the net profit margin. And just check here, you see in 2007, asset turnover was 2.67. The net profit margin, where was it? Was 11%. And so the return on capital, 29%. Is that what we got? Yes, 29.37. Whereas in 2006, the net profit, the asset turnover 3.02, the net profit margin 8.5, and so the return on capital 3.02 times 8.5 is 25.7%, 26%. And again, was that what we got? Return on capital 25.65, 26%. Yeah. So I'm repeating what I said. I appreciate, but we want always the return on capital to increase. It'll because it's these two multiplied together. We can achieve it by either increasing the net profit margin or increasing asset turnover, or both. So here, net profit margin went up. We did well. Asset turnover went down, albeit the two together were okay. And of course, they can be related. Maybe the way we got the net profit margin up was by charging a higher price. But as a result, maybe the sales themselves fell a bit, which is why the asset turnover went down. So to look at them in isolation is a bit dangerous. It depends on our policies, but it's just analysing why or how the return on capital employed changed. All right, so there are the profit measures that you need to be aware of. The next one is liquidity. The next section. How easily can the company pay its bills is the main thing. And the most basic measure of all there is the current ratio And the current ratio, as you've got in front of you, is current assets over current liabilities. So let's check from those statements. The current assets, inventory, receivables, cash at 2314. The current liabilities are 965. And so the current ratio is 2.40. Now, in fact, this is one of the few ratios, we leave it as a ratio, not a percent, but it's one of the few that means something on its own, as opposed to needing to compare, in that we're saying in the short term, the company's going to get in money of 2314, some of it's cash, some of it's receivables, but it will turn into cash, and similarly inventory. In the short term, they're having to pay out 965. And so surely, if the company is going to be able to stay in business, we need the current assets to be greater than the current liabilities. We need this to be more than one. If ever it was less than one, we've got big problems. How are we going to pay our bills? Or even if it was starting to approach one, it would start to be worrying. What was it last year? Last year, assets 1401, sorry, beg your pardon, current assets 1679, current liabilities 704. Uh, 2.38. So there's hardly any change. Not a lot we can say there. Okay, it's more than one, and so there's no short-term problem. You know, if it was, even if it was still above one, but if over a period it was going down, I may start to get worried. Why is it going down? Maybe in the future we'll hit a problem if we don't do something. Also, though, although we want it more than one, we don't want it too high. You don't want to have too much money just lying around if it's not needed. And what's a reasonable level really depends on the type of business. You know, some businesses need to carry very high levels of inventory. Some businesses have very high levels of receivables. Other types of business don't. And so it's a combination of things. We want it to be more than one. But again, to check whether it's actually 2.4 is a reasonable level, looking at similar businesses would be quite useful. The next one, the quick ratio, the acid test, is very much the same sort of thing. Except, if we're talking about how easy to pay our bills, our payables, maybe we pay our payables in a month. We take a month's credit. How are we going to pay them? Well, obviously any cash lying around is already available to pay the payables. Receivables, well, that will take time. But, you know, if we're taking a month to pay our payables, hopefully we're collecting our receivables in within the month. As that money will be available. But the problem is inventory. That although we could have loads of inventory, it may take a while before we actually sell them, and if we're selling on credit, it takes longer still to get the money in. So in the very short term, the money from inventory perhaps isn't available to pay the payables. And so the acid test ratio does the same as current ratio, except we ignore inventory because of the problem I just mentioned. And so current assets minus inventory. In 2007, current assets 2314, take out the inventory, and we're left with 1308. Current liabilities 965, and so the current ratio, the quick ratio, I get 1.36. Obviously lower than before, and obviously you'd expect it to be much closer to 1. Here it looks healthy enough. What about 2006? 1679 current assets minus 871 inventory. is 808. Current liabilities are 704. So what do we get? 808 divided by 704. A 1.15. Okay, that's gone up this year. There's not a lot we can say though. It's closer to 1, but there still doesn't appear to be any panic. All right, the next one's still under liquidity. Oh dear, I've got so many sheets here. Try and get them in order. The next one, looking at individual items of the working capital, because the working capital, the current assets to current liabilities, things like receivables. Any business surely wants to collect its receivables as fast as it can. You're forced to give credit because of competition. If competitors give customers a month's credit, we're going to have to give them a month's credit, but even so, if we're managing efficiently, we want to collect the money in as fast as we can. And so in fact, I'm going to do them in a slightly different order than they printed, because the most obvious, I think, I'm going to look at the receivables days, which is the top one on the next page, or as you can see, the average collection period. Let's have a look and see if we can estimate approximately how many days credit are we giving customers, how quickly are we collecting in the money. Again, you've got the formula, I hope, yes you have. Trade receivables, in 2007 we know what the receivables were, it was 948. The total revenue, 7180. So the receivables are that proportion of the revenue for the year, assuming 365 days in a year. That suggests it's taking us are we giving 48 days credit to customers. Now, a couple of things there. Strictly, we should be looking just at credit sales. All we knew here was the revenue was 7180, so effectively I had no choice but to assume they're all on credit. If you were given a breakdown, credit sales, cash sales, well, it's credit sales that we're interested in. And secondly, and a big problem with a lot of ratio analysis, but particularly here, we've had no choice but to use end of year receivables. And they may be unusually high because just before year end we had a lot of sales, or they could be unusually low. You know, much better would be to look at sort of the average over the year. But normally, all we've got available is the end of year figures. So it's receivables at the end of the year as a proportion of total revenue for the year. So it does appear it's taking us 48 days to collect the money in. And as always, you can't really say whether that's good or bad. You want to get the money as soon as possible. If competitors are giving 30 days credit, they're managing to get the money in. Why are we taking so long? On the other hand, if competitors are giving 2 months credit, we seem to be doing rather better. You know? Check in the exam if this is relevant, how many days. Sometimes they say assume 360 days in a year. Trivial thing, but even so, we would obviously change it. Anyway, what about last year? If things got better or worse? In 2006, receivables 708. In 2006, revenue 5435. So without repeating the limitations I just mentioned, it seems as though last year we were taking about 47.5 days. So nothing much has changed there. If it had gone up in 2007, I'd be worried, you know, why are we taking longer? What are the reasons? If it had gone down, it would look good. Here, Can't really say much unless we have similar companies to compare with. That's receivables days, but we can do the same sort of thing for the same sort of reason with both inventory and payables. So if you go back to the previous page, inventory days, it's measuring how long inventory is staying in inventory. You know, you want to sell your goods as fast as you can. But if goods are sitting in inventory for 3 months or something before we sell them, that's very worrying. You know, perhaps we'll never sell them if they're there for 3 months. The faster we sell, the better. And so, back to the previous page, we take the inventory, so 2007 again first, the inventory, 1006, divided by the cost of sales, 5385. And again, unless told differently, 365 days in a year. And so 1006 divided by 5385 times 365. I get 68 days. Now, it does seem rather a long time. It's taking us over 2 months to sell the goods. But again, it depends so much on the type of business as to how rapidly you can sell them. What was it the previous year? The things seem to have got better or worse. Inventory was 871. Cost of sales 4212. 871 divided by 4212 times 365. 75 days, which again, without knowing what business we're in, that does seem horrendous. So at least we've managed to get it down a bit this year, but it still does look rather high. Incidentally, not in the notes, but that can be, you can add it in. You can look at this in a slightly different way. Instead of looking at inventory days, you can look at inventory turnover. And inventory turnover is cost of sales divided by inventory. So in 2007, cost of sales 5385, inventory 1006, which is 5.4. Leave this as a number. So the cost of sales was 5.4 times the inventory, whereas in the previous year, 4212 over 871 was 4.8. And so you can see by comparing them that inventory days, the shorter the better, and we have managed to reduce it a bit. On the other hand, inventory turnover, the higher the better, the faster the inventory is being sold and replaced. Anyway, finally, on these working capital ones, we looked at receivables days, how quickly we're collecting in our debts. Similarly, we can look at the payables days, which I hope is on that sheet, yes, or the average payment period. Exactly the same sort of thing. It's the trade payables, which in 2007 were 653. Now, strictly, we should be dividing by the credit purchases, the purchases on credit. And if you know the figure, then obviously use it. Most times we don't. You only get summarised statements. We don't even know total purchases here, and so we've no choice but to use cost of sales 5385. So I hope you're understanding me. If I had given more information and you knew what the credit purchases were, you would use that figure. But given we don't, and generally you don't, approximation, round use cost of sales. Again, times 365, and let's total differently. Uh, 44 days. So we're taking 44 days, it seems, to pay our liabilities, and the longer we can stretch it, the better, within reason. I mean, obviously, if you take too long to pay, you risk people refusing to supply, but subject to that, the longer you take to pay, the better it is. What was it in 2006? Trade payables 516, cost of sales 4212 gives us 45 days. So again, it's hardly changed. It seems okay. Incidentally, two of these, in a sense, go together. We seem to be taking around 44 days to pay our liabilities. We're taking 48 days to collect in our receivables. Now, ideally, if you think about it, ideally, you'd want to collect your receivables in at least as quickly as the time you're taking to pay your payables. Now, there's not much difference here. 2007, we're taking 48 days to collect money in, but we're paying out within 44 days. So there's not much difference, but even so, it would be better if it was the other way around, that we were collecting money in faster than we're paying it out. All right. Lastly, if I can find my sheet again, was gearing. Now, in fact, gearing is very unlikely to be relevant in F5, even though you should have heard of it. It's much more relevant when we come to F9, but we'll worry about F9 later. But gearing is looking at your long-term finance. We've already discussed that in 2007, 2,190 of our money is coming from shareholders, 500 of our money is coming from long-term borrowing. Well, gearing is looking at the ratio, what proportion of our money is coming from long-term borrowing. And there are actually two ways people measure it, and which give different answers, but if ever you're asked to do gearing in paper F5, you would be told how to measure it. One way is the way that I've written there. The long-term liabilities, long-term debt borrowing, which 2007 is 500, as a percent of the shareholders' funds, capital plus reserves, 2190, which in percentage terms, 23%. So the debt is 23% of the equity. What was it last year? The debt was 400, shareholders' money 1401. It was 29%. I'll say a few words about this in a minute, but clearly the gearing has gone down this year. I did say there was another way of measuring it. The other way of measuring it is your long-term liabilities as a percentage of the total long-term borrowing. So shareholders' funds plus long-term liabilities. And so if we did measure it that way, in 2007, the long-term borrowing was 500. The total long-term finance, equity 2190. Long-term borrowing 500, so a total of 2690. And on this measure, the gearing would be 18.6%. Obviously different than before, it's a different measure. In 2006, what would it be? 400 over 1401 plus 400. Oh, a lot higher if I got my arithmetic right. 400 divided by 1801. Oh no, 22.2%. So either way, but if it was ever required, you would be told which way they were measuring it. And obviously, you had to do both years the same way. And of course, in both years, here they've fallen. Now they both fall, they both go up, because the proportion of debt is lower. Now, to carry on chatting a lot here would be wasting your time, because gearing, I'm not saying it couldn't be asked in F5, but it's extremely unlikely. So again, it's F9. F9, you could be asked to write a lot about this. But with gearing, you can't really say whether higher or lower gearing is good or bad. One attraction of gearing, of borrowing money, is that you're having to pay interest on it, but the interest is tax allowable. You see, shares, share borrowing, you're having to pay dividends, and it doesn't save you any tax. With debt borrowing like this, okay, you pay interest instead, but that does reduce the profit, the taxable profit, and you do save a bit of tax, which is attractive. On the other hand, more gearing makes things more risky for the shareholders, which may upset them for all sorts of reasons, but the most obvious of all being if the company that whatever profit we make each year, it's the interest has to be paid first, whatever happens. Shareholders only share in anything that's left. So if you have lots and lots of borrowing, lots and lots of interest, there's risk that there's not much left for the shareholders. Anyway, that's more than enough on gearing. And there we are, there are the measures you need. Can I say what I said at the very beginning? That there's not much on pure financial performance measurement in paper F5. You will not be asked a whole list of ratios like on that page, but certainly one or two of them could be relevant in any exam, but the trouble is it could be any one or two. So check you've got them, and I think the good or bad is fairly obvious. It says at the end limitations. We'll have a read, but I've already mentioned as we went through the limitations of ratio analysis. But do have a read and make sure you could write a few words. All right, so that's financial performance measurement.